So, Peter, thanks for joining us. Now, the bankers today released its FY21 results, and there's a lot happening as always, including a buyback this year. But perhaps firstly, you can just give us your take on the key numbers and the drivers behind it and the underlying business performance.
Well, hello, Michael. Good to see you again. Yes, it's the 2021 result for Westpac. In terms of balance sheet, we're very strong, 12.3% capital ratio, and that's seen the board approve a buyback of $3.5 billion. Credit quality is very good, so we saw some improvement in credit quality despite the impacts of COVID, and that was reflected in our profit. So our profit rose strongly off the back of a turnaround in credit impairment charges, which were actually a benefit this year. So we had a strong increase in profit as well.
Now, just on the buyback you mentioned, perhaps you can talk us through the thinking behind it. So I'm talking about the size, the structure, and what it means for shareholders.
So in terms of the buyback, capital ratio ended at 12.3. That's the Common Equity Tier 1 capital ratio, and that's well above the 10.5% APRA unquestionably strong benchmark. So we felt like we had excess capital. The board had a look at that. It had a look at the performance of the business, credit outlook, and the success in selling businesses and what we've got in the pipeline. And we decided that $3.5 billion was the right amount to return to shareholders through a off-market buyback. On a pro forma basis, allowing for the buyback and announced deals on selling businesses, we end up about 11.8% in terms of the capital ratio. So that's still very strong. The reason we chose an off-market buyback is we have plenty of franking credits, which we're unable to return to shareholders soon. So we decided to do an off-market buyback, and that benefits both dividends per share and earnings per share in the future because we reduce share count through the buyback.
At the first half, you unveiled a pretty notable cost reset plan targeting an $8 billion cost base by 2024. But you also noted at the time that costs were going to come through in the second half, and they have jumped a bit. So perhaps you can walk us through what happened there and the outlook for costs.
Yeah, well, if we step back, we're looking at more competition in the sector. Lower interest rates are impacting margins, so we think it is the right thing to reset costs. And we've chosen $8 billion in FY24, and we have a clear plan to deliver that. There's a couple of key parts of that plan. The first is to exit our specialist business division businesses, and you saw some progress on that this half and more to come. The second is to reduce notables, so reduce some of the issues that we've had in risk management. So we want to do that. We've also got a significant investment in our fixed priorities, over $1 billion this year that we invested in fix. And we see that dropping away over the next 3 years as we improve our risk management. And that was also a big driver of our second half costs in terms of increasing investment in fix. We also saw a little bit more unused leave. So we didn't have as many people taking leave because of COVID, and that'll come back in the future. But we've got a plan, and then that leaves us with about a $9 billion cost base sort of for the run business, which we are targeting to get to 8 by FY24, and that's the plans that our CFO Michael Rowlands talked about today.
And just on the notables you mentioned, they've again had a big impact on the result. This time around, there was also the write-down of goodwill in WIB. So I'm interested in your views on the future there, because it sort of suggested you see a bit of a weaker earnings outlook, but there's also the positives in institutional banking in terms of rising rates and also just the transition to net zero as, you know, a lot more sustainable finance deals come along and such. So can you just unpack all of that?
Yeah, so what we've done over the last 18 months is reset that institutional business. So we've exited a few geographies. We've come out of energy trading. We've reduced risk in financial crime by reducing the number of correspondent banks and low interest rates, as you said, and they've all reduced revenue. And under the accounting standards, we need to look each year at whether or not the intangibles can be supported through the revenue at this point. That was combined with a very soft markets trading outcome this year, and particularly this half. So when you put it all together, the resetting of the business, the markets trading issues that we've had, it wasn't a good revenue period in WIB, and that's been reflected in the valuation. And so we wrote down the goodwill and the software capitalisation and a couple of other assets associated with WIB. Now, I'm confident that WIB can grow from here. I see the opportunities both domestically in terms of helping customers. I think the climate response and the investment that's going to go into the economy, including electrifying the economy, is big, and our business is well set up to take advantage of that. So I think the future's good. Rising rates will be better for the institutional book. They're pretty low at the moment. So unfortunately, we had to be realistic about where the business is at the moment after the reset, but we feel like we've got a good business and it's turning around.
Now, and a positive of the result is the continued momentum in mortgage growth. And if we look across the industries, there's a lot of focus at the moment on processing and turnaround times, given just the massive number of applications that have come through in the last year or so. And so do you feel like you've got your arms around those issues and you can actually start taking those learnings and start using them to improve the business book?
Yeah, well, in mortgages, it's been a focus area since I came into the role in 2019. It's taken a couple of years, but we've seen good improvements again in both first and third party. Not saying where we aspire to, we have more work to do, but I've got a clear plan to get there. We particularly saw good growth in owner-occupied in this period, a little bit down in investor as we were a little bit more conservative than others in the market in terms of borrowing capacity, but I was very happy with the progress we've made, and I can see the pipeline to improve from here, particularly as brokers get the benefit of some of our digital processes that have been rolled out to our first party channel this year. And then if I look into business, again, we'll be applying the line of business disciplines into business lending. In WIB, interestingly, we had a very good fourth quarter in lending. We were supporting customers in M&A and other domestic transactions, which was an opportunity that we really grasp, and I can see it coming through in agriculture, some property, and more broadly in our SME business. But the techniques that we're using in mortgages, we will definitely be rolling out to business lending.
And just speaking of the property market, it's pretty hot out there, obviously, and we've seen the regulator step in recently and increase the buffer banks use when they assess whether people can repay under higher interest rates. I'm interested what you think that means for the market, i.e. prices, credit growth, and do you think they might actually have to do more if it doesn't cool down out there?
Well, in terms of the housing market, there's still plenty of demand, and we can see that in activity in the market, and there's not as much supply. So you get these situations where supply doesn't match demand and therefore price goes up. But the question the regulator asks is it leverage that's driving prices? So whenever housing growth debt is growing faster than income growth, that's the right question to ask. And so they've really tapped on the brakes through changing the buffers. When we look at our measures of affordability that our economics team puts out there, stretch. So it is the right thing to be doing. We'll see whether or not more needs to be done. But they're very much looking at the dynamics of high debt to income, high LVR, interest only investor lending when they decide what to do. So I support the measures.
And just on the economy more broadly, it's been pretty stunning. It's remarkably resilient given what we've seen with lockdowns in the two biggest cities in recent times. I mean, as you look into 2022, what do you think is the key thing we're going to need to keep this momentum going?
Well, I think it's the consumer. So if I look at activity, if the consumer's out there being active, spending, they've saved a lot of money, then that's good for business. Business employs people, and you get economic activity. So I think it's the consumer's the key. The big debate in markets is about interest rates and where they go, obviously, but I think the heart of it is about the consumer, and it always takes you back to unemployment, and it's good that we're seeing fast rebounds in activity and people getting jobs again, because that's what will drive 2022.